A newly signed law called the Secure Act was created to expand ways all of us can save for retirement. The changes go into effect tomorrow, and one area that's going to be impacted is investing in annuities. Joining us now to talk about what this means for investors as well as your 401k is Ramsey Smith, founder and CEO of Alex.fyi. And Ramsey, joining us from Key Largo, say hi to Humphrey Bogart. So how does this work? There's going to be an annuity now offering perhaps in my 401k. Should I be worried? Because I see those ads on TV that say, beware annuities.
All right, so first things first. I want to say that the Secure Act is a really big win for the American consumer. And it's a big win for a number of reasons. For one thing, as proof of that, it had bipartisan support. It passed in the House 417-3. So there's a lot of agreement on what this can do. It's actually going to take some time before we see the actual implications from an annuity perspective be rolled out. Essentially what it does is it makes way for the provision of annuities and 401k plans. Historically, that is not something that was done for a variety of reasons. One of them was an issue around potential liability for employers. And so employers have been given safe harbor that allows them to proceed to add annuities to the mix without creating undue liabilities for them on a going forward basis. So at the end of the day, what's happening here is that consumers are going to have more choices, and more choices are better as far as I'm concerned. And then secondly, annuities are going to be part of employee-sponsored plans, and there's a lot of great benefits for that, including greater cost efficiencies.
So it seems as like it's also a big win for the industry that's offering these annuities, right? Because they'll have probably bigger customer base to choose from. Is there anything that people need to be aware of when they are looking at these various choices?
So I'm going to answer both parts of that question. First part of the question is it good for the insurance industry? And I think it is. I think it's going to bring more attention to the benefits of annuities. It's going to create broader availability. It's going to create availability to potentially smaller clients. So in that sense, it's good for the insurance industry. But at the same time, I think it's fantastic for consumers because your employer is going to be able to negotiate essentially on your behalf to be able to get you potentially fantastic deals. My hypothesis is that this is going to be a very, very competitive market. And in fact, I think the insurance industry is going to have to do a lot of work to set up for a business that's going to be built around lots and lots of potentially small accounts as opposed to fewer.
The issue is really that you're assuming that the employer is going to have the wherewithal to negotiate, and you're talking about fees specifically. I think that the unspoken risk in all of this, and I agree with you that more choice is generally better, but annuities specifically are very complex. There's a number of there's variable annuities, fixed annuities, indexed annuities. They're complex instruments, and investors in their 401ks who are trying to save for their future, being asked to make those additional decisions and analyses without necessarily having access to financial professionals that can walk them through that in a fiduciary capacity, I think raises some real risks and some dangers. And we just don't know all the answers. As you said yourself, it's going to be months, if not possibly a year or two, before we fully understand the trickle-down effect and the impact of all of this. So my advice to anybody who would be asking me would be calm, be careful, and understand the risks.
Let me take up what you're saying, and I have a question for you, Ramsey. Let's say for this question, you have $100,000 in your 401k. You're in your late 40s, early 50s, and now you get this annuity option. If you're looking at putting, $100K into the annuity, I think fees can be anywhere from 6 to 10%. Are you looking at losing $10,000 just for the privilege of putting that money into an annuity that would then guarantee you income when you retire? How is this going to work?
All that remains to be seen. For one thing, you could wait till closer to retirement to buy the annuity, and you can invest in stocks and bonds in your or stock and bond mutual funds in your 401k in your earlier years if you so choose. And I think the fee issue here is a very important point. Now, and from my prior visits to your show,
yes,
that I'm a strong believer in very, very simple annuities that look as much as possible like traditional pension plans, or Social Security. Those tend to have lower fees, and you know what? They can go even lower, and they're very, very they're as simple as you can get in terms of the annuity offer. So what I would like to see the market share of simple annuities, so that would be immediate annuities and also deferred income annuities, grow dramatically on the back of this. So I'd much rather see growth in those particular types of annuities versus variable and other types of more complicated annuities.
All right, thank you, Ramsey.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.